A very good day to Dr. Tamina. We are from Group 10 would like to present about Ajinomoto's ratio analysis. Before that, let me introduce my group mates. Starting off with me, I am Sargunan Ilangovan, Tumesh Ravitharan, Rishi Raj, Arif Muizuddin and Fancy Chen. Without further ado, let's start off with the introduction of the company. Ajinomoto was founded in 1909 by Dr. Kikune Akeda and Saburusuke Suzuki II in Japan. The company revolutionized the food industry by discovering monosodium glutamate, which is known as MSG in short form, as a flavor enhancer. This firm is inspired by the unique umami taste found in kombu seaweed. They've introduced the world to MSG. This led to the launch of their first product, which is Ajinomoto, marking the beginning of the new era in culinary innovation. Today, their legacy lives on as pioneers in taste enhancement and seasoning solution globally. Ajinomoto operates at the intersection of the food and health industries by delivering innovative solutions that enhance everyday life. Its core product includes seasoning, prepared food, beverages, and frozen foods, catering to diverse culinary needs worldwide. Beyond its product range, Ajinomoto invests heavily in biotechnology research, driving advancement in food science and health solutions. This commitment enables the company to address global challenges such as nutrition, sustainability, and well being, solidifying its position as a leader in both food and health sector. Ajinomoto has established a strong presence across Asia, North America, and Europe, making it a truly global company. The firm serves both consumer and business markets. Ajinomoto meets diverse needs with its expertise in flavor development and nutritional solutions. The company's unwavering focus on innovation and sustainability drives its mission to create a value while addressing global challenges. This approach has solidified Ajinomoto's reputation as a leader in enhancing flavor, nutrition, and overall well being on a worldwide scale. These are the 5 financial ratios analysis that will be presented by me and my group mates. Now, I would like to pass the floor to Arif.
Hello, Doctor. My name is Arifin bin Doblin, and I'm continuing with the liquidity ratio slide. This slide provides an overview of Ajinomoto Malaysia liquidity ratio from 2019 to 2023, highlighting the company's short-term financial health. The current ratio, which measures total current asset against liability, dropped from a strong 8.12 in 2019 to 1.77 in 2023. This decline reflects a reduction in current asset from 455.7 million to 242.2 million, an increase in liability to 136.7 million. The quick ratio, which exclude inventory, fell from 7.33 in 2019 to 1.27 in 2023, indicating a growing reliance on inventory to cover liabilities, which is less ideal in financial strain. Finally, the cash ratio, which consider only cash and equivalent, dropped from 1.9 to 0.42 over the same period, raising concerns about the adequacy of cash reserve. Overall, this consistent decline suggests increasing reliance on less liquid asset and a weakening short-term financial position, which we'll analyze further in the next slide. This slide showcases the trends in Ajinomoto Malaysia liquidity ratio from 2019 to 2023 through a detailed column chart. Each ratio reflects key aspects of the company financial flexibility and short-term solvency. Now, starting with the current ratio in blue, there's a steady decline from 8.12 in 2019 to 1.77 in 2023. This drop is attributed to a significant reduction in current assets such as cash and receivable, alongside a rise in current liabilities. It indicates that the company's ability to cover its short-term obligation has weakened over the years. Next, the quick ratio, shown in red, decreased from 7.33 in 2019 to 1.27 in 2023. The fall suggests a shrinking base of liquid asset excluding inventory, which makes the company more reliant on its stock to manage a liability, which is a less desirable scenario, especially during financial difficulty. Lastly, the cash ratio represented in yellow shows the sharpest drop from 1.9 in 2019 to just 0.42 in 2023. This reflects a considerable decline in cash reserve, potentially due to higher operational costs, reinvestments, or reduced profitability. It raises concern about Jadimo's ability to meet immediate cash-based obligation. This declining trend collectively points to increasing financial strain and reduce the liquidity buffer. The company's growing reliance on non-liquid assets such as inventory underscores potential challenge in managing short-term liability efficiently. That's all from me. Thank you.
Good day, Doctor. My name is Rishi Raj, and today I will be presenting the activity ratio analysis. But before that, let me explain what is the activity ratio. Activity ratios measures how efficiently a company uses its assets and manages receivables to generate sales and cash flow. So the first variable that we're looking at is the account receivable turnover, which is the net sales divided by the account receivables. So this variable has improved from 4.27 in 2019, which is 85 days to collect, to 9.143 in 2022, which is 38 days to collect, but slightly declined to 8.759 in 2023, which is 41 days. This shows better collection efficiency overall. The second variable, which is the total asset turnover, which can be seen as net sales divided by total assets, it has fluctuated starting from 0.840 in 2019, dropping to 0.609 in 2021, and recovering to 0.814 in the year 2023. While improving, it hasn't surpassed the 2019 level, showing room for better asset utilization. Last but not least, the average collection period, which can be seen as accounts receivable divided by revenue and divided by 365. So tied to receivables turnover, it dropped from 86 days in 2019 to 38 days in 2022, stabilizing at 41 days in the year 2023. This indicates faster cash collection overall. In summary, the company's receivable management has improved, but there is still potential to optimize their asset usage. Thank you. Now let's look at the bar chart for a clear visualization. So the accounts receivable turnover, the purple bars, improved from 4.27 in 2019 to 9.41 in 2022, showing efficient collections with a slight dip to 8.76 in the year 2023. Now, the average collection period, the yellow bars, reduced from 86 days in 2019 to 38 days in 2022, stabilizing at 41 days in the year 2023, indicating faster receivables collection. And now, last but not least, the total asset turnover, which is the green bars, fluctuated but improved to 0.81 in 2023, showing a better use of assets. With that being said, that'll end my part. Thank you, Doctor.
Now, let me continue with the leverage ratio. There are two ratios, which is debt to asset and debt to equity. The debt to assets formula is total liabilities will be divided with the total assets. From 2019 to 2022, the debt to asset has been increased from 0.13 to 0.31, and it has slightly reduced in 2023, which is 0.29. This shows that the company Ajinomoto has increased its debt from 2019 to 2022, and it has slightly decreased in 2023. And this indicates the portion of Ajinomoto's assets financed by debt. Next is the debt to equity, which is the total liabilities will be divided with the common stock equity. As we can observe from 2019 to 2022, this has also increased from 0.15 till 0.44, and it has slightly decreased in 2023, which is 0.40. This shows the company Ajinomoto has increased its financial risk from 2019 to 2022, and it slightly decreased in 2023. This indicates the portion of financing coming from debt versus shareholders' investments. Now let's have a look at the bar chart for a clear visualization. As the blue color bars are representing the debt to assets, and the green color bars are representing the debt to equity. As we can see from this bar chart, it is increasing from the year 2019 to 2022, and there is a slightly decrease in 2023 for the both ratios. This shows the company's financial risk has been increasing from 2019 to 2022, and there is a slightly decrease in 2023.
Hi doctor, my name is Tumesh, and today I'll be presenting about profitability ratio analysis. A profitability ratio measures a company's ability to generate profit relative to revenue, assets, and equity. So let's analyze the financial data from 2019 to 2023. The net profit margins saw a step decline from 12% in 2020 and to below 4% in 2022, showing a weak recovery in 2023. The operating profit margin followed a similar trend, dropping from 16% to under 2%, likely due to rising operational costs or inefficiencies. So earnings per share also hit a low in 2022 before improving slightly in 2023. So ROA and ROE dropped consistently, so highlighting reduced assets efficiency and lower shareholder returns. So however, with minor improvement in 2023, the company may be on a recovery path. So yeah, thank you. Okay, so let's look into the graph. So the graph illustrates financial performance trends from 2019 to 2023. The top graph shows decline net and operating profit margins. So with the sharpest drop occurring between 2021 and 2022, the second graph highlights the fall in earnings per share, ROA and ROE, all hitting their lowest points in 2022. So however, 2023 shows a slight improvement, suggesting potential recovery. So these trends indicate that while the company faced profitability challenges, a turnaround may be underway. Thank you.
We analyze the market rationale from the price earning per rationale, book value per share, market to book rationale, ATAC. According to the formula, we calculate the price earning per rationale from 2019 to 2023. For example, the price earning per rationale in 2019 is 41.186 and the price earning per rationale in 2020 is 22.13. Book value per share is calculated by dividing the number of shares by the total number of ordinary shares, which gives a value of 1.02 for 2019 and 0.92 for 2020. The price to book ratio is calculated by dividing the market value and each share by the book value of each share, which can be calculated. The value for 2019 is 1.157 and the value for 2020 is 1.67. Ajinomoto behind conduct a team trend analysis from 2019 to 2023. The market price earnings per share is used to calculate the earnings per share of stock for the year. The price earnings rationale declined significantly in 2020 and 2021, indicating that the growth of market price has not kept pace with the improvement of earnings per share, or the company's profitability has increased. By 2022 and 2023, the price earnings ratio picked up again, but did not return to the high levels of 2019, indicating that the market's expectations for companies have improved from 2019 but remain cautious. For the book value per share ratio, book value fell to 0.92 in 2020, showing that the company's book equity has shrunk. From 2021 to 2023, the book value per share gradually increased from 1.04 to 1.11, indicating a steady increase in the company's net assets. The price-to-book ratio has gradually increased from 1.57 in 2019 to 2.83 in 2023. which indicates that the market is video the company at an increasing pursuit. The market is more optimistic about the company's future profitability and growth year by year, especially reaching higher levels in 2022 and 2023. The company is at a shows a trend of improvement year by year, and the market's recognition for its assets and profitability is increasing.
Now, let's have a look at the market return. In order to find the cost of debt, we have to divide the interest expense with the total debt, which is equivalent to 1.7%. Next, the after-tax cost of debt, where the cost of debt times with the open bracket 1 minus tax rate and close bracket, which is equal to 0.46%. The cost of equity, where the risk-free rate plus the beta times with the market return is equal to 1.55%. Last but not the least, in order to find the weight of debt and equity, the market capital and the total debt must be added together, and it is equal to 2140,4013,819. The weight average cost of capital, which is known as WACC in short form, where we have to open bracket insert amount cost of debt times with the total debt amount, close bracket, then plus open bracket again in order to insert the cost of equity amount times with market capital and close bracket. After multiplying the four amounts in two separate brackets, then plus the both amount, and we will get 4.23%. Now let's have a look at the security market line graph. The blue color line indicates the SML line, which is slanting upwards from left to right. Next, we can see there is a red mark on the beta axis and on the expected return axis, where the beta is negative 0.28 and the expected return is 1.55%. The grey color dotted line indicates the risk-free rate, which is the horizontal line in the graph. That's all from me. Thank you.
Ajinomoto Malaysia has shown areas of concern, particularly with liquidity and profitability. But there are promising signs of recovery. To ensure sustainable growth moving forward, we recommend a focus on several key strategies. First, improving liquidity through better cash flow management. Optimized inventory and stricter credit policy will enhance financial flexibility and reduce short-term risks. Second, balancing debt and equity is crucial. While there has been a slight improvement in leveraging in 2023, the company must continue to moderate its reliance on external financing and maintain an optimal capital structure to reduce financial risks. Third, cost management and operational efficiency must be a priority. By adjusting pricing strategy and addressing efficiency, Ajinomoto can enhance its profitability and safeguard against rising operational costs. Additionally, exploring new market or product lines will be vital for long-term revenue growth and generating shareholder value. Lastly, monitoring and improving operational efficiency should be an ongoing goal to maintain the company competitive edge and financial health.
And now moving on to the conclusion, Ajinomoto Berhad's financial performance from the year 2019 to 2023 highlights both strengths and challenges. Liquidity ratios, including the current, quick, and cash ratios, have steadily declined, indicating reduced financial flexibility and difficulties in meeting short-term obligations. Profitability metrics like net profit margin and return on assets also face significant declines, largely due to the rising costs and operational efficiencies. However, in the year 2023, it brought some positive signs, with activity ratios showing slight improvements, reflecting better asset utilization and progress towards recovery. On the upside, the company benefits from a low weighted average cost of capital, also known as the WACC, of 4.23%, which supports value creation by lowering the investment hurdle rate. Despite this, high leverage ratio remains a notable concern, emphasizing the need for careful debt management. Looking ahead, Ajinomoto must prioritize enhancing liquidity, managing costs effectively, and improving operational efficiency to achieve long-term stability and growth. And with that being said, let's move on to the references. Now, to wrap it all up, this is our references that we have used to complete this assignment. And with that being said, thank you, Doctor, for your humble attention. And this is us from Group 10. Thank you, Doctor.